Yeah, so covered call ETFs, they've just been increasingly popular. We've been getting more and more questions on them. More advisors have been recommending them. More ETFs have been created. More fund managers are pushing them. So it's really, should you even consider them? Are they useless? Are they great? Are they amazing? And yeah, I'll get into that. So they come in various forms, but we can really look at the commonalities and the general structure of them. It is like a normal ETF, but then on top of it, they sell call options against them, against the underlying assets, which can vary between stocks. They can do cryptocurrencies. They can do gold. They can really do anything that has options traded against them. But the most common is a various stock index, whether it's the S&P 500, the Nasdaq, the TSX 60, the Russell 2000, or like we'll look at in a minute or two, the big six banks. It has to be really something like that. The way the covered call ETFs work is the same way covered calls really work on individual stocks, except it's against those baskets of assets. Essentially, you give up a degree of upside price increases for a period of time in exchange for a premium or a cash payment to you at the time of the sale of the call option. The ETFs might use terminology in their description, such as covered call or things like enhanced yield, high yield, and so on, things like that. So if you are seeing those descriptors, that might be what they are doing. Covered call ETFs, they do have some limitations. The requirement for covered call ETFs is they have to have an active options market, which does limit really the potential underlying. For example, you have covered call ETFs on those indexes, S&P 500, TSX 60. As those indexes, they have active option markets. But if you wanted specifically a covered call index on Canadian small cap stocks, you're really out of luck. You're not going to have those. If you've looked at Canadian option markets as a whole, they're generally pretty illiquid, and then they're just non-existent. They are not even exchange traded for small companies. However, there do exist covered call ETFs on more liquid stocks in the Canadian market with liquid options, such as the Canadian Big Six banks, and we'll get into that one in the middle, like I said. Also, the big discrepancy between some of these ETFs is whether they're actively or passively managed. So passively managed ETFs will use a systematic approach to their option writing, meaning it follows really a rule-based system, selling options at a certain out of the money percentage for X length of time. So maybe 1 month, it might be 3 months, it might be a year out, and they'll use a very strict rule-based set. Or you have actively managed ETFs, which are very discretionary and are less strict when it comes to the manager's choices. So what I mean by choices, they may include things like the strike price or the out of moneyness of the option. So how far is if you're trading something at $100, are they going to choose to sell it at 105, 110, 150, and so on? And as well, then the amount of fund that is actually covered by option. So you don't need to necessarily write covered calls against all your underlying. It could be only 50%, which is very common, or it could be 100%. And as well, some of these covered call ETFs, they actually use leverage on top of it. Normally, it's quite minor leverage. It'll be anything between one times, which is unleveraged, or 1.5 times, which is an additional 50% leverage on top of the usual amount of being unlevered. So the general trade-off between actively managed and passively managed is that the actively managed funds have really the goal of beating their covered call index, either through lower volatility and or higher returns. But they likely have higher fees as they're doing more work towards it, and they won't always even outperform their underlying index. The easiest way to see really the pros and cons of covered call ETFs is to really compare it to a standard ETF with the same underlying but no derivatives being used. So compare an S&P 500 covered call ETF to the SPY ETF, the most common ETF in the world, or the most commonly traded, I should say, the most liquid as well. The benefits of covered call ETFs are being an income strategy. The funds commonly distribute those premiums and potential dividends from the underlying. They have reduced volatility as you are selling call options, which reduces your sensitivity to the underlying stock or index. Normally, you can see that if you are looking at a covered call for an individual stock, you normally see it expressed in delta. So if you sell covered calls, it might be a 0.3 delta. A stock will have 1 by default. So then you end up with a 0.7 delta, which means you're only 70% sensitive to the stock price movement. Overall volatility is lower. You don't really need to dive into that deep, especially when you're just looking at the ETFs. It does have as well downside protection compared to non-covered call ETFs, as you collect that premium by selling the potential upside, meaning in a scenario where the underlying is either flat or down, you'll either receive a positive return or a lower negative return compared to that standard ETF. In Canada, covered call ETFs are generally just tax efficient. They're taxed capital gains, whereas in other jurisdictions, options might be taxed income, a standard income, which then is less tax efficient than compared to capital gains. Switching to the cons of covered ETFs, reduced capital upside. In a strong bull market, a covered call ETF will drastically underperform the non-covered call version of an ETF. Only limited downside protection. Unlike a protective put, you only receive a premium, which will mitigate the downside risk. But if the underlying really collapses in price at a fast rate, like if you look at the COVID drawdown in 2020, the premium protection will only be a drop in the bucket of what is actually in the downside. The faster the price increase is, the less useful really a covered call is as a hedging tool, as it doesn't have that time to have the premiums decay and really give you that premium protection. Covered call ETFs as well, they have higher fees compared to your standard ETF. The degree of an increased fee largely depends on the exact management style as well as the complexity of the call option strategy deployed, as there is variance in the strategy deployed. So quickly looking at the Malville Bank ETF CBNK on the TSX, which is one of our viewers asked about, which was prompted this discussion. The fund targets a 7% annual yield with additional capital growth opportunities. Like all covered call ETFs, it will have some sort of capital gain, and then it will have some sort of distribution goal. The underlying is the big six Canadian banks, ranging from 14.2% to 18.3%. So nearly equal weighted. Really, they're an equal weight benchmark with slight discrepancy, and that's very common with actively managed funds. But they deploy a 1.25% leverage, meaning they are using margin loans to amplify returns, as well as losses. And the benefit really, the additional benefit is they can write more call options against that additional stock as they are leveraged. The ETF has a current yield of 9.63%, with distributions being $1.69 since its inception in March of 2022. As well, the ETF has a management expense ratio of 0.65% or 65 basis points against the net asset value or NAV, which is higher than what if you were to have something that is the same asset compared to this. However, since the inception of the ETF in March of 2022, the fund has declined in total value, which includes distributions of 6.3%. If we can compare it against an equal weight bank ETF of the big six banks of HEWB, the underlying is effectively the same until the active management comes into play. The total return for CBNK is a negative loss of 6.3%, whereas HEWB had a positive return of 1.9%. And these are total return figures, by the way, so they include distributions. So overall, the covered call ETF CBNK had actually underperformed a comparable investable ETF. When sometimes you're comparing to indexes, those indexes you can't really invest in. Well, here is an investable choice. You have a similar ETF, and yet it is underperformed in a relatively down to flat market, which is where these are meant to perform. And this is largely due to the leverage nature of a covered call ETF in this case. So moving on, I'll just really close it off with some general thoughts. The most important part of a covered call ETF is still the underlying. It's still going to drive the risk and returns. Options are ultimately a strategy which alters the risk and return, but does not overhaul it. It does not change it drastically. It just kind of pokes and tilts the risk reward scenario. If you do believe in the efficient market buy hypothesis strongly, which you're a passive investor, that's likely what you do believe or what you are relying on, covered call ETFs will always underperform due to the higher fees. This effectively means that if you are a purely passive investor, you have no expectation to beat the markets, just stick with a normal ETF. That is due to the higher fees. Holding all else equal, although I don't believe in the efficient hypothesis theory in a strong manner, if you do believe that you are a passive investor not trying to beat the market, covered call ETFs will underperform. That being said, there are specific cases due to temporary market conditions or the belief of that, where covered call ETFs can be affected. But if those cases do arrive, you can probably just sell covered calls on your own accord and do that on a discretionary basis, be your own active manager instead of relying on one of these ETFs. And lastly, just to drive the point home, here are a couple more examples of covered calls underperforming. Here, XYLD is an S&P 500 covered call ETF. Comparing it to the index, it's underperformed by about 6%. First, comparing 7.2% average return compared to 13% over its time period since inception in 2022. And even comparing without the fees, the transaction fees, the taxes, and all that, which you can't avoid, even though many of these indexes, they'll just ignore them, it's 11%. So even the covered call strategy, comparing that to a normal ETF, it underperformed. So if you are a long-term holder, why would you be using a covered call ETF? And then we can look as well for the TSX 60, comparing two indexes. So they ignore those taxes, the transaction fees, even though you will have those in the real world. If you want to compare like to like, the annualized returns over 10 years were 6.5% versus 7.8%. They had brief periods of overperformance, but when you are looking at these long stretches of time, these covered call indexes, even indexes without including the higher fees, will end up underperforming over time as you are taking off risk. So just generally, if you are a long-term holder, just get the standard ETF. Don't get fancy.
It's interesting. It looks like if you are going to hold a covered call ETF, you have to to be successful, predict a specific set of market conditions are going to be upcoming and have it invested in that ahead of time. You probably have a better strategy that you could use than that as well. So yeah, again, I mean, that's just the data that you put out there in terms of how they performed over the long term, and they've been outperformed by a far simpler product if you want to.
Yeah, exactly. And if you do have those
better.
Yeah, if you do have those views, you're probably a sophisticated investor to the point which
you can
you're
use
capable of selling
strategies.
the options on your own. Yeah.
Exactly.
Yeah. Interesting. Aaron, you're muted. Sorry. You're muted, Aaron. Sorry, man.
Or you just think you're a sophisticated investor. But I think that this goes back to Ryan's segment on behavioral psychology. I mean, here we have this category of asset that looks very attractive because they pay these high yields. But when you look at the performance over time, they've actually underperformed after fees and taxes. They've underperformed simpler assets, right? So that yield is really just an illusion. It's an illusion that's created likely to encourage people to get involved because they see, oh, I can, make a 10, 15% yield in some cases. But, one of the things
unit price declines. We've seen it for years.
Exactly.
Right?
And one of the things that I've read is that like the yield that you're getting now is basically you're getting that because you're giving up stock price returns, like appreciation from the underlying portfolio. So it's not like you're getting this yield. It really is kind of like an illusion, right? Like the misdirection that a magician would use, right, in one of their shows. So yeah, it's not, generally speaking, I mean, we find the leveraged ETFs, the covered calls, the more complicated products don't really add value to investors. Err towards simplicity.
But they do give vehicles for the investment industry to charge you more.
Oh, so they're brilliant for that.
Isn't that amazing?
Brilliant for that.
They're great at that. The fees get to be higher, so it's great. And yet the data seems to suggest that they underperform over the long term.
The data is what we have. So just look at the data. That's all we
can go on. Yeah.
And these the last two slides I had up
commission off of your purchase. So the data,
and these are look at the fund performances for these. They have to legally provide them on their websites. You can normally see they might have brief periods of outperformance. Try to look at long term. Some of these are only a year or two old, and they might have a brief, it overperformed the market by 1% during this period. But then once it's existed for 5-10 years, that 0.6 to 1% fee is probably just going to eat that away anyways, even if they were able to match the index.
Excellent. Well, I think that's a good answer. And, I think that video should go around. And when anybody is asking about whether they should invest in a covered call ETF, they should watch that and look to see, what the data suggests in terms of performance over the long term.